What is FDIC actually doing right now behind the scenes, to the best of your knowledge?
Yeah, I mean, there are really two big things going on right now. One is the deployment of the deposit insurance fund, which doesn't happen very often, about once every decade or so. And so they're working through that process in conjunction with the Fed. And then the second thing they're doing is running the acquisition process for Silicon Valley Bank and Signature Bank. So, they've got data rooms open. It looks like a traditional investment banking M&A process. And then the third thing that's probably got a lot of people losing sleep is they're running around looking at all the other banks in their portfolio, trying to make sure that there aren't other hidden problems out there that they didn't catch in the examinations over the last few years, like they did with Silicon Valley Bank and Signature Bank.
Caroline, what was so interesting for you and I starting the week was the sigh of relief on that backstop. And we're learning, actually, it's still incredibly complicated for a depositor to kind of pivot, on their strategy with banking.
Yeah, ultimately, a lot of VC funds out there saying for them, or indeed their founders, look, this isn't that easy to just go about and diversify your funding. A lot of bigger banks, JP Morgan being named by some of them, saying, look, you need a much higher initial base of money to be able to put in. Some of those minimums are just out of their reach. And Sultan, from that perspective, how much do you think the FDIC at the moment plays its role, but ultimately might have to change course, or indeed regulation might have to change course down the line, so that people can still access funds when they need them, but ultimately we're not all swallowed up by some larger systemic institution?
This is a perfect example of the second and third order ripple effects that probably aren't going to be thought through for a little while at the federal regulatory agencies. Silicon Valley Bank in particular had such an outsized impact in terms of where it was holding deposits across the startup ecosystem, especially the venture capital ecosystem, that redistributing that across 5, 10, 15 banks, even if it is amongst the too big to fail banks, becomes an entire restructuring of that ecosystem. And it's going to take months, if not a few years, for that to really shake out.
Sultan, you wrote an op-ed, and it's actually been raised again in your LinkedIn, for example. You wrote it for Bloomberg, in fact, back in 2022. When you left the FDIC, you left it as Chief Innovation Officer, saying that ultimately that the FDIC is a technophobe. You said the federal bureaucracy is both hesitant and hostile to technological change. How much at the moment are we seeing a changing of the role and way in which banking is executed being a problem for regulators and institutions?
Well, over the last 2 decades, we've seen a tremendous change in banking. Everything is digital now. Everything is based on technology. The movement of money is a real-time digital function, whether it's on your smartphone or at the central bank level. And we are decades behind in terms of using automated technologies to analyze these kinds of issues, whether it's a liquidity crisis or a depository crisis, or just even watching the flow of funds. We've seen issues where some of the FHLBs have actually run out of money to ship. And so, we're at a point where the entire regulatory infrastructure really needs to be upgraded to the 21st century. And that was one of the things that really concerned me when I was inside, and certainly part of the motivation of writing that op-ed.
Sultan, we've got some breaking news that indeed the US is pushing First Republic to be rescued with banks after the stock slump. So we still see First Republic stock down some 20% on the day. We're seeing a slight recovery as Bloomberg is reporting that the United States, their officials are pushing First Republic for a rescue with banks after the stock slump. And fascinating the speed with which this continues to envelop regional lenders.
Yeah, and Bloomberg reporting it's all the banks you'd expect, right? JP Morgan, Citi, Bank of America, Morgan Stanley are all part of those discussions, according to sources. Sultan, Caroline and I were so excited to have you because you've sat at both sides of the table now, the FDIC, and you are in the world of technology, foundership, backing yourself.
Yeah.
How does this play out in the real world economy for startups? All of these headlines that cross. If you're sitting there trying to run a business, how worried should you be?
Well, I'm going to break this answer up into 2 pieces. One is, if I'm the operational manager of a startup, I should have my capital distributed amongst a number of institutions. Large money center banks are great from the too big to fail and safety and soundness perspective. But in terms of products and services, maybe they're regional or smaller banks that make more sense. And so you have to be a reasonable manager there. From a, figuring out what to do with my business, that's an entirely different conversation. We're seeing a real cultural fight going on right now between digitally native people who want digital technology in their banking and financial system, whether it's, fintechs or crypto or any of these other, more modern ways of using technology, and a regulatory environment that's fundamentally still analog. And this conflict is pushing and pulling, and I think we're going to see a lot of impacts. There are a lot of companies that I'm looking at, whether as potential or current investments, that are kind of wondering if they should even be operating in the United States because of some of these conflicts. And maybe it's better to leave the States for a few years and then come back. So what this has done is institute a lot of, I think, ambiguity about where you should be as an operational manager. And certainly a lot of us are looking at this, for the first time, really saying, we've got to, be very thoughtful, understand the regulatory environment, the political environment, the capital environments, and also where the customers are. And there's a lot of, I think, 2023 doesn't look a lot like 2019. I'll say that.
I mean, Caroline, we shouldn't make light of any of this, but we're going from sort of one crisis to the next. Crypto and what happened with Silvergate, for example.
Yeah.
There's a chain effect happening here.
Silvergate signature. And I want to get your perspective on this, Sultan, actually, because there seems to be a growing anxiety among crypto founders in particular that they're in some way being blocked out of the more mainstream financial ecosystem, unable to find lenders to provide for them. And this is actually a concerted effort. Do you believe that?
I do. I'll break up this answer a little bit. So first off, Silicon Valley Bank in particular held a tremendous percentage of venture debt. In a lot of ways, they really created that market. It's north of 40% of that market, and that's just gone, right? And that's usually, kind of a post-A round kind of, funding structure. It is absolutely clear that in the last year, there has been a nudge, and it's moving from a nudge into something much stronger than that by certain parts of the regulatory community to get the crypto ecosystem out of the United States banking system. And we see it from examiners telling banks not to bank certain people to now something a little stronger. There's a bit of a rumor going around about, telling whoever buys Signature that they can't bank crypto if they do that. And so, there's until Congress actually creates a legal structure for this, I feel like we're going to be in a situation where, it's just easier for crypto not to operate inside of the American banking system.